So, hello and welcome to today's class. Today we are talking about the special topics in financing, this advanced financial management, and special topics in financing. It has several components. It has several components, and to be specific today, we talk about adjusted. Talk about adjusted present value. Adjusted present value, that is APV. Now, for adjusted present value, it is just like any other, the normal NPV. The difference between APV and NPV is that APV uses both, considers both financing and investment aspect of the project, while NPV only considers the investment aspect of the project. And of course, APV also brings in the concept of risk. It considers the risk specific to a project, while NPV assumes that all projects in the company are affected by the same level of risk. Now, in calculating APV, 3 steps are involved. Step number 1 is calculate best case NPV. Calculate best case NPV. Now, the best case NPV, it is similar to normal NPV, except that cash flows are discounted. Cash flows are discounted using ungeared cost of equity. Ungeared cost of equity. That is we use the BA, the asset beta. And we know that cost of equity equals to RF plus RM minus RF, we multiply by the BA, sorry. So sometimes examiner will give you the asset beta. It's upon you to know that you need the, sometimes the examiner will give you the equity beta. It's upon you to know that you need the asset beta. So we apply the Hamada model to calculate the asset beta. Then our step number 2 is to determine the issue costs on equity and debt used to finance the new project. We calculate the issue costs. Then step number 3, calculate calculate the present value of interest tax shield. Calculate the present value of interest tax shield. And in calculating the present value of interest tax shield, we prepare a loan amortization schedule to determine the annual interest, from amount borrowed, So the interest is then discounted using risk-free rate of return. It's not only the interest, but the interest tax shield. And of course, the interest tax shield is simply you take your interest, you multiply by tax rate. So let's have an illustration on those tested in 2013, June 2013. Question 3B. June 2013, question 3, boy. So June 2013, question 3, boy, that's what we have there. Now, Blades Limited is considering diversifying its operations away from its main area of business, that is food manufacturing, into the plastics business. So be careful where the company is going to invest. The company is going to invest in the plastics business. So am I very much concerned with what will be happening in plastics business, not in food manufacturing? The company wishes to evaluate an investment project which involves acquisition of a molding machine that costs shillings 450 million. The project is expected to produce net annual operating cash flows of 220 million for each of the 3 years of its useful life. The salvage value is 0. The assets of the project will support debt finance of 40% of its initial cost, including issue costs. So that means when raising the 450, we shall raise 40% of it, 450 shall be raised from debt. The loan is to be repaid in 3 equal annual installments. The balance of finance will be provided by placing of new equity. Issue cost will be 5% for equity and 2% for the loan. Debt issue costs are allowable for tax. Plastics industry has an average equity beta of 1.268. That is the equity beta in the plastics. But remember, that's where we're concerned with. Currently, we are in food manufacturing. We are going to invest in plastics. And where we're going to invest, the equity beta is 1.368. The average debt to equity ratio is 1:5. Blades Limited's current equity beta is 1.8. 20% of its long-term capital is represented by debt, which is generally regarded to be risk-free. Risk-free rate of return is 10%, and the expected return on an average market portfolio is 15%. Tax is 30%. The machine will attract 70% initial capital allowance, and the balance will be written off evenly over the remainder of the asset's life and will be allowable against tax. Those are just the depreciations. The firm is certain that it will earn sufficient profits against which to offset these allowances. Using adjusted NPV, advise whether or not the project is worthwhile. When you look at our steps, the first step was to get the best case NPV. And in best case NPV, we start by getting our cost of equity. We start by getting our cost of equity. So very important, very important. Let's get the cost of equity. So we need to get the best case NPV. Let us get KE, which equals to RF plus RM minus RF. We multiply by the beta, BA. Unfortunately, we've been given the BE. We know that BA equals BE times, we open the brackets, value of equity plus value of debt adjusted for tax. So can do 1 minus T, close the brackets, and everything divided by value of. We're looking for the BA. BA should be BE divided by VE plus BD adjusted for tax. Adjusted for tax. So there we are told that the value of equity. So we are looking at the plastics industry. Our BE is 1.368 and debt to equity is 1:5. Debt is 1, equity is 5. So our BE 1.368 1.368 times debt was 1, equity is 5. So 1 debt is equity is 5 divided by 5 plus 1 adjusted for tax. Yeah, that's okay. So therefore we have that is using the calc 5 plus 0.7, that is 5.7. So 5 divided by answer. Then we multiply by 1.368. So having 1.2. 1.2. So therefore our KE becomes the risk-free rate of return, we are told, is 10%, and the return on the market is 15%. So we are having 10 plus 15 minus 10. And this one, we multiply by 1.2. That gives us 16%. So 16%. So we have our year. We have year 0, year 1, year 2, and year 3. The figures are in millions of shillings. We can start with the initial outlay. And in year 0, we spend 450. 450. Then we have the earnings before depreciation and tax, the pre-tax cash flows. In year 1 paka year 3, I think we're given a certain figure there. The annual operating cash flows of 220 for each of the 3 years. That is 220 for each of the 3 years. 220 and 220. We can less tax. And the tax rate was 30%. So 30% of 220, that is 66. So we less the 66. And you're supposed to add the DTS. The DTS. In the first year, we are told in the first year it was to be 70%. The assets of the project will we were told somewhere the machine will attract 70% capital allowance in the first year. So capital allowance in the first year, we are having 70% of 450 times 30%. The tax on debt. Tax on debt. So we're having 70% of 450 times 0.3, 4.5. 94.5 in the first year. Then the balance we've been told about the remaining, which is 30%. The remaining, which is 30%, of the 450 times the tax rate. Times the tax rate will be depreciated evenly. So hiyo 30% ambayo ilibaki itakuwa depreciated for the remaining 2 years. So we multiply by a half for each year, a half. So times 0.5. So we're looking at the 30% of 450. So the 40.5 that we have, we divide it into the remaining 2 years. So divided by 2. divided by 2. That is 20.25 for each one of them. 20.25, and we have 20.25. That gives us the net cash flows. So net cash flows is the summation. Now, after having our net cash flows there, let us we need to discount those cash flows. We need to discount those cash flows. In discounting, we put here our PVIF. The cost of capital we got it was 16%. So at 16%. The discounting factor of 16%. Year 1 is always, year 0 is 1. Year 1 we have to be checking the table. 1 divided by 1.16. That is 0.8621. Then divided by 1.16, we get 0.7432. Then the other one you're having divided by 1.16, 0.6407. 6407. 0.6407. Then of course the best case NPV so we multiply that is our best case NPV. That's our step number 1. Step number 2, we need to get the present value of issue costs on debt, issue cost on debt and equity. And very easy, amount to raise from debt. We're told that debt financing will support the project by 40%. The assets of the project will support debt finance of 40% of the initial cost. The amount raised from debt becomes 40% of 450. So 40% of 450 is how much? 40% of 450, that is 180 million. And of course, the balance will be raised from equity. So amount to raise from equity will be the remaining 60%. 60% of 50 million. Which equals to 270. Shillings 270. Now the issue cost. Now this debt, the amount raised from debt of 180, we have the issue cost on debt. The issue costs will be 5% for the equity and 2% for the loan. So 2% for loan. So here you're having at 2%. And this other one will be at 5%. So therefore, the issue cost on debt, remember, after raising the total amount of debt, I should have raised, the total amount that I'll raise from debt should be 100%. And this 100% should be a total of the amount I need to invest plus the issue cost. So meaning if issue cost on debt is 2%, then the amount I'll invest in the project should be 98%. So that 98% plus 2% is the total amount raised from debt. So the issue cost on debt becomes 2 divided by 98 times 180. Two divided by 98%, those are the percentages. You multiply by 180. So get the issue cost of how much? 2 divided by 98 times 180, 3.67 million. 3.67 million. Then of course, issue costs on equity would be 5/95 times 270, which equals 5 divided by 95 times 270, 14.21. So step number 2 is done. Step number 3, we need to get the present value of interest tax shield. So total amount to raise from debt, this one should be equals to the amount that the project required, which is 180 million, plus the issue cost of 3.67 million. That one equals to 183.67. So we need to get our annual installment. Annual installment, which equals to amount of loan divided by PVFA. The cost of debt was 10%, as we were told, and this loan is being paid over a period of 3 years. Debt is risk-free, so meaning the cost of debt is the risk-free rate of return, which is 10%. So the amount of loan is 183.67 divided by, so the annuity 10%, 3 years, so the annuity 10%, 3 years, what we have? $2.4869. 2.48. So therefore, annual installment becomes 183.67 divided by 2.4869, which is shillings 73.86. So prepare the loan amortization schedule. So this one requires the period, we have the beginning balance, so beginning balance, we have the installment. Installment comprises of two components. Partially, we are paying the interest, and partially, we are paying the principal. And of course, we have the end balance. Good. So the figures are in millions of shillings. So we have our year 1, year 2, and year 3. As we start our first year, our loan balance is 183.67. In that year, we pay installment of 73.86. 73.8. And for information, installment is fixed for each year. Interest, the interest rate was 10%. So this one equals to 10% of the beginning balance. So this one equals 10% of the beginning balance. %10 of the beginning balance. So 10% of the beginning balance. The principal amount of loan equals to the installment that you are paying is covering two components. You are partly paying the interest and partly paying the principal. So out of the 73.86, interest is 18.37. How much is the principal? So this one equals the installment minus interest. And it will be the case all through. Then finally end balance. As we start our year, our loan balance is 183.67. This is the amount of loan that we are repaying. So we remain with how much? So this one equals the beginning balance minus the principal. And of course, the balance at the end of year 1 becomes the balance at the beginning of year 2. So here equals to 128.2. As we end our year 2 is 67.16, is the same amount we start with the year 3, 67.16. You can see our loan balance at the end of the year. The decimal point is because of the rounding off errors, but it's roughly 0. That's what we expect. Then let's have the interest tax shield. Now the interest tax shield is simply we take our interest, we multiply by the tax rate, which is 30%. So therefore, interest tax shield of year 1 equals the interest times 0.3. Interest times 0.3. We can actually discount it because we need the present value of interest tax shield. Tulisema kuwa we discount the interest using the risk-free rate of return. So you can have here our PVIF at 10%. The risk-free rate of, coincidentally, the risk-free rate of return is the same as the cost of debt in this question. So for the first year, you're having 10% 1 year, 0.9091. The second one, 0.8264. And the third one, 0.7513. Therefore, if you can get the present value, so present value, the interest tax shield times the PVIF. And of course, now our present value of interest tax shield the total of these. Good. So in conclusion, if we take best case NPV, if we take the best case NPV, then we add, we less issue costs, on debt, we also less the issue cost on equity, then we add present value of interest tax shield. The answer that we get is our adjusted present value. So from our illustration, our best case NPV is 5.37. The issue cost on debt, we are told that issue cost on debt are allowable for taxes, so just adjust for tax. So issue cost on debt becomes that one, so equals to This is 5.376, sorry, 376. This one here. So then the issue cost on debt, they were saying, we're told that debt issue costs are allowable for tax. So having 3.67 adjust for tax, 1 minus 0.3. So that becomes 2.5, 2.569. We're supposed to be lessing this one. Then you have the issue cost on input, which is 14.21. So 14.21. And we add the present value of interest actually, which is 9.701. 9.701. And that, of course, gives us our adjusted present value. As simple as that. And because it's a negative, we are told to advise. Because it's a negative, the project is not worthwhile. The project is not worthwhile. So that is it. For the special topics in financing, to be specific, the adjusted present value. Unless there's any question from your end, we can have it at that point. And I welcome you to subscribe to the YouTube channel, share, give your comments so that you can help me improve this channel. Wish you all the best as you prepare for your forthcoming exams. May you get the right knowledge to help you pass. Have a good evening or a good day and good time.